Navigating the speed of change is, well, it's essential these days, isn't it?
Absolutely. Whether it's cybersecurity or just business performance in general.
Right. And getting a handle on the latest numbers, understanding expectations, and really digging into the why behind it all, that's crucial.
Exactly. Which is what we're doing today in this deep dive.
We are. We've taken a close look at a company's recent quarterly earnings presentation and the press release that went with it.
That's right. Focusing specifically on their first quarter results for fiscal year 2026.
And that quarter just wrapped up not too long ago, ended April 30th, 2025.
Pretty fresh data then.
Exactly. So our mission here is simple. Go through these sources, pull out the key figures, spot the important trends, and understand the projections they're making.
To give you a clear picture of where things stand, according to the company itself.
Okay, let's unpack this.
So, starting with that Q1 snapshot, fiscal 26, the sources kick off with some pretty significant financial results.
They usually lead with ARR,
Right.
ending annual recurring revenue.
That's the one. A really critical metric for these subscription businesses. It tells you about the predictable revenue stream.
So what was the number?
Ending ARR hit $4.44 billion as of April 30th.
Okay. And how does that compare?
Importantly, the sources point out that's a solid 22% growth year over year. So, decent expansion there.
And the new business just in this quarter, net new AR.
For Q1, they added $193.8 million in net new AR.
You might see that rounded slightly sometimes.
Yeah, maybe to $194 million in some spots. But $193.8 million is the specific figure for new subscription revenue added in those 3 months.
Got it. Okay, what about total revenue for the quarter?
They reported $1.10 billion.
And compared to last year?
That's a 20% increase compared to Q1 of fiscal 25, which was $921 million.
And the subscription part of that?
Also strong. Subscription revenue was $1.05 billion, which again showed that same 20% year-over-year increase. Consistent growth.
Okay, so solid growth on the top line, ARR and total revenue. Now, profitability and cash flow. This is where it gets interesting with GAAP versus non-GAAP.
It is. And the sources definitely focus heavily on their non-GAAP figures.
Right, so maybe we should quickly clarify what non-GAAP means here.
Good idea. It's basically a way companies present results, excluding certain items they feel aren't part of their core regular operations. Things can vary company to company.
So for this company, what were their Q1 FY26 non-GAAP numbers?
Okay, non-GAAP income from operations was $201.1 million.
And earnings per share?
Non-GAAP diluted EPS came in at $0.73.
And I heard the cash flow numbers were quite good.
Very good, yeah. Record numbers, actually. They generated $384.1 million in cash flow from operations. Call it $384 million rounded.
A record, wow. And free cash flow?
$279.4 million, or $279 million. That gave them a free cash flow margin of 25% for the quarter.
Generating that kind of cash is definitely a positive signal.
Absolutely.
Okay, let's just circle back quickly on non-GAAP. What specific things are they pulling out to get to those numbers? It helps to understand.
Good point. The main exclusions are things like stock-based compensation, so equity given to employees.
Which can be a big number, especially in tech.
Exactly. Also, amortization of acquired intangible assets, specific charges from what they call the July 19 incident, and costs tied to their strategic plan restructuring.
So items they see as one-offs or non-cash charges not reflecting the day-to-day business profit?
That's the idea behind how they present it, yeah.
And didn't they mention a change in how they calculate non-GAAP recently? Something about taxes?
Yes, they did highlight that. A couple of tweaks. They now include employer payroll taxes related to stock comp within the stock comp line itself.
Okay.
And they adjusted how they calculate the non-GAAP income tax expense. They're using a consistent long-term projected tax rate now, which is 22.5%.
So aiming for a more standardized view of their non-GAAP profit.
That seems to be the goal, yes.
But it is important we look at the standard accounting view, too, the GAAP numbers. The press release shows a different picture there for Q1.
It absolutely does. Under GAAP, for Q1 FY26, they reported an operating loss of $124.7 million.
A loss, okay.
And a net loss of $110.2 million, which works out to a diluted GAAP EPS loss of $0.44 per share.
That's quite a contrast to the non-GAAP profit, and different from last year's GAAP result, too.
Yes, last year in Q1, they actually reported GAAP income. So this highlights just how significant those excluded items like stock comp and those incident costs are on the standard accounting bottom line this quarter.
So the takeaway is Strong cash generation and operating profit if you exclude certain big-ticket items the company flags as non-core.
Right.
But the standard GAAP accounting shows a loss for the specific quarter and their overall cash pile.
Very healthy. The sources note a record balance of cash and cash equivalents. Yeah. $4.61 billion as of April 30th.
That gives them a lot of flexibility.
Definitely.
Okay, those are the headline numbers. But the real question is, how did they do it? What's driving this performance according to the sources?
Yes. This is where the narrative really focuses on their platform momentum.
The Falcon platform.
Exactly. They position it as an AI-native XDR platform.
Okay, quick clarification. XDR, extended detection and response. What does that actually mean for someone listening?
Good question. Think of it as pulling security data from lots of different places, not just laptops or servers, but cloud stuff, identity systems, networks, everything.
To get a bigger picture.
Right. A more unified view of potential threats across the whole environment. The goal is faster, better detection and response.
And AI native means AI is built in from the ground up.
That's the implication, yes.
Yeah.
AI capabilities core to how it works.
And this platform is pretty broad now. How many modules?
They mentioned it spans across 30 modules now, and they talk about a huge potential market opportunity.
Like what kind of numbers?
Well, they cited figures like $20 billion for security and IT ops, another $20 billion for managed services, $17 billion for cloud security, areas the platform addresses.
That's a massive potential market. And a key part of getting customers onto this broad platform seems to be something called Falcon Flex.
Yes, Falcon Flex comes up a lot. It's positioned as a really critical growth engine for them. It's about how customers buy and use the platform.
So how does it work? What is it?
Think of it like a flexible spending account for their security modules. Customers commit to a certain amount over time.
Instead of buying specific modules one by one.
Exactly. And then they can deploy any module on the Falcon platform whenever they need it. Endpoint, cloud, identity, whatever, all under that single flexible contract.
Ah, so it makes it easier to try out and adopt more things on the platform. Less friction.
That's the idea. Simplifies buying, encourages consolidation of other point products onto Falcon, reduces complexity for the customer. And the sources have some really interesting stats on its impact.
Okay, let's hear them.
So, accounts that have adopted Flex now represent over $3.2 billion in total deal value.
Wow, $3.2 billion.
And that figure is growing incredibly fast. They said more than 6 times year over year.
6 times? That's huge growth.
It is. And the average deal size for these Flex customers is also significant, over $1 million on average.
A big commitment. What about actually using it after they sign up? And expanding.
Another key point they highlighted, over 75% of the value in existing Flex contracts is already deployed, meaning customers are actually using the capabilities.
Okay, so it's not just shelfware.
Apparently not. And, maybe even more importantly, over 75% of those existing Flex customers are coming back for what they call a Dear Flex.
Oh, a Dear Flex. What's that?
It basically means they're expanding their commitment, either increasing the total spend or adding more capacity, likely because they're using more modules.
So it's driving expansion within the customer base, too.
Precisely. It suggests they're happy and seeing value, enough to double down. And this momentum showed up big time in Q1.
How so?
Total Flex account value added just in Q1 was $774 million.
$774 million in one quarter.
Yep. And that was up 124% compared to Q1 last year.
Wow. Okay, so Flex isn't just talk. The sources clearly show it's driving serious, fast-growing deal value.
It's definitely presented as a core engine right now. And related to that, they also shared metrics on module adoption.
Right. How many tools people are actually using on the platform?
As of Q1 end, 48% of their subscription customers had adopted 6 or more modules.
Almost half using 6 or more. That's quite broad.
Yeah, and 32% were using 7 or more, and 22% had deployed 8 or more modules.
What does that signal?
It suggests customers really are consolidating onto the platform, not just buying 1 or 2 things. It fits that Flex narrative.
Makes sense.
And they specifically called out Next-Gen SIEM. Its ending ARR grew over 100% year over year.
SIEM, security information, and event management. That's a core security tool. Big growth there suggests the platform is being used for foundational stuff.
Exactly. And beyond adoption, retention looks good too. The CEO mentioned sustained 97% gross retention.
That's keeping existing customers.
Right. And consistently strong net retention, which includes the expansion revenue, like from reflexing. Both strong is a good sign.
And partners. Are they helping drive this?
Definitely. Sources said 60% of Q1 deal value was sourced by partners.
60%. That's a lot.
It is. And over 15% came via the MSSP channel managed security service providers. Partners are clearly key, especially maybe for those bigger deals.
Speaking of big deals, any numbers on those?
Yes, they mentioned large deals, which they defined as over $10 million.
Okay.
Those grew 113% year over year, which again ties back nicely to that Flex story driving bigger multi-module commitments.
So the picture from the sources is clear. The Falcon platform, supercharged by this Flex model, is leading to bigger deals, wider adoption, good retention, and strong partner input.
That's the narrative connecting the strategy to the Q1 numbers, yes.
Right. Beyond the core financials and drivers, the sources also mentioned recent product updates and industry recognition.
Yeah, they listed quite a few innovations, things like Falcon Privilege Access Management.
Managing sensitive user accounts.
Right. And more AI stuff like Charlotte AI, agentic response, and workflows using AI to automate security actions. Plus, AI security for AI.
Like what?
Like AI model scanning to find risks in AI models, and detecting shadow AI employees using unapproved AI tools.
That sounds very current. Other areas.
They also mentioned updates to Falcon Adversary Overwatch, their managed threat hunting, plus Falcon Data Protection and Falcon Exposure Management.
So securing data and understanding overall risk. Seems like they're adding capabilities across the board.
Pretty much. Core threats, AI, data, risk, and analysts seem to be noticing.
What kind of recognition did they highlight?
Well, for cloud security, they were named a leader in the 2025 Frost Radar for cloud and application runtime security.
Okay.
The SOITA specifically noted they got the highest score on the innovation index there and were called the only CNAPP delivering unified real-time protection.
CNAPP, Cloud Native Application Protection Platform, that bundled a lot of cloud security tools, right?
Exactly. CSPM, workload protection, vulnerability management, all integrated. So being a leader there, especially with that real-time note, is significant for their cloud story.
And they got nods for XDR and ITDR too?
Correct. Leader and fast mover in the Gigiom radar for XDR, which reinforces that core platform message, and leader and outperformer in the Gigiom radar for ITDR.
ITDR, Identity Threat Detection and Response, focusing on user accounts being attacked.
Yep, a critical area, so recognition there matters.
And collaborations, any mentioned?
Yes, they mentioned working with Microsoft on tracking threat actors and an expanded partnership with Google Cloud.
Okay.
They even highlighted winning the Google Cloud Security Partner of the Year award for workload security. Partnerships with the big cloud players are important.
Definitely. And finally, FedRAMP High. What's that about?
That's a big one for selling to the U.S. federal government. FedRAMP High is a tough security standard for cloud services handling sensitive government data.
So achieving that opens up more government business.
Precisely. It's a high bar to clear.
Okay, so summarizing this bit. The sources show ongoing innovation across the platform, backed by positive analyst and partner validation, plus hitting key government certifications.
It reinforces the message that the platform is evolving and gaining market credibility, according to these third parties.
All right, we've looked at Q1 and the why. Now let's look forward. The sources provided guidance for Q2 and the full year.
They did. For Q2 fiscal 26 ending July 31st, 2025, they're guiding for total revenue between $1,144.7 million and $1,151.6 million.
And non-GAAP profitability for Q2?
Non-GAAP income from operations projected between $226.9 million and $233.1 million.
Okay.
Which translates to non-GAAP net income between $209.1 million and $213.8 million. And non-GAAP EPS guidance of $0.82 to $0.84.
How does that guidance compare to the Q1 results we just discussed?
It implies continued growth sequentially, higher revenue and higher non-GAAP operating income and EPS compared to Q1's $201.1 million and $4.73. And the full year. Fiscal 2026 ending January 2026.
The full year guidance is total revenue between $4,743.5 million and $4,805.5 million.
Quite a range there, and full year non-GAAP profit.
Projected non-GAAP income from operations between $970.8 million and $1,010.8 million. Getting close to $1 billion there.
Yeah, and non-GAAP net income expected between $878.7 million and $909.7 million. Which gives a full-year non-GAAP diluted EPS range of $3.44 to $3.56.
Now, these are projections looking pretty far out. How much weight should we put on these based on what the sources say?
Ah, yes, the crucial fine print. The sources are very clear look for the forward-looking statements sections.
The disclaimers.
Exactly. They state these are expectations, not guarantees. Actual results could be very different due to lots of risks and uncertainties.
Like what kind of risks?
They mentioned things like potential ongoing impacts from that July 19 incident, effects from their strategic plan changes, fierce competition, the macroeconomy, financial result fluctuations, the usual suspects, plus specifics detailed in their SEC filings.
So, standard but important caveat. These are estimates. The future is uncertain.
Absolutely essential context.
So given that, what's the company's stated rationale for this guidance? Why are they confident, especially about the full year?
The CFO's comments give some insight. He specifically mentioned conviction in net new ARR reacceleration
So, faster growth in new business.
and margin expansion, happening specifically in the second half of this fiscal year, so after Q2.
Okay, so they expect things to pick up later in the year. Why?
He points back to the drivers we discussed. Continued momentum with Falcon Flex, strong win rates against competitors, and what they see as a robust sales pipeline building for the second half.
Got it. So they expect flex, win rates, and the pipeline to really drive acceleration and better margins later this year, justifying the full year numbers.
That's the story presented, based on their current visibility. And one more thing, they announced a share repurchase authorization.
Buying back their own stock.
Yes, up to $1 billion. The sources present this as a sign of confidence in their future financial health and cash flow.
Okay, so let's tie this all together. What does this deep dive into their Q1 results and outlook really mean for you, the listener?
Well, based on these sources, you've seen a company that reported a strong Q1, good ARR and revenue growth.
Driven largely by that Falcon platform and the flex model, according to them.
Exactly. That flex model seems key to landing bigger deals and getting customers to use more modules. Plus, they showed solid non-GAAP profit and record cash flow.
And importantly, you now have their official forecast for Q2 and the full fiscal year. You know the numbers they're aiming for.
And you know the metrics they track, ARR, flex adoption, module expansion, and why they feel confident about hitting those future targets, thinking particularly about that second half acceleration.
And crucially, you also understand the caveats. These are projections, not promises, subject to real-world risks.
Right. It's about getting that deeper source-based view beyond just the headlines, understanding their numbers, their story, and their own expectations.
It definitely gives you a much richer understanding of the business's health and trajectory as they see it.
Indeed. Moves you past just surface-level takes.
So here's a final thought based on all this. Considering the really significant impact this Falcon Flex model appears to be having, driving big deals, pushing platform adoption, as shown in these results and their outlook, how might this trend, this customer preference for more consolidated, flexible ways to buy security, actually reshape the whole competitive landscape? How might it force other cybersecurity vendors to adapt their strategies in the years ahead? Something to think about.